Welcome to Accounting High.
Check out the Cashflow Show. We discuss topics like getting paid on time, profitability, and managing your bottom line, payroll best practices, the best apps to use, and cash flow forecasting tools. So if you're a small business owner, your help's right around the corner. Fret not. Tune in as Scott and Nikole help you reach your goals on the Cashflow Show. The Cashflow Show. Listen and learn. We'll show you how to pay yourself on what your business earns. Show. Tune in with Nikole and OKR.
What's up, Nikole?
Hey, Scotty, good to see you.
Notice I went back to Nikole and not Nikki.
Yes, had to go back to Nikole.
We've reverted back in one episode. We've went from one name back to the other. Let's go, Nikole. So last week we said this is R&D tax credits for everybody, not just for tech companies. But now we got an episode that's for tech companies. What are we talking about today?
That's right. So we are doing a 3-part series on tech companies. I may have said this before on the podcast, but what I've realized over the years is there's really 3 foundational types of businesses. One would be that we sell time. So that's like our service type business. Another type of business would be selling things. So you have inventory. That's another business model. And then the third type of business is we are building something to sell later. A lot of times that's like a tech or SaaS based business. And so all 3 of these types of businesses have different challenges, different levers. What I want to go through is some key terminology for the startup space with SaaS metrics and terminologies, so that as if you're an advisor and you're working with this type of client, you understand the challenges that they have versus your service type business that may have revenue already coming in the door versus a startup model business, which they have investors, they have a limited amount of cash that they're dealing with, and they're growing really quickly because they go from 0 to getting funding straight away. And so it's just, they have different challenges. So I want to make sure we address those so that you can, if you're advising them or if you're in it and you're trying to get funding, that you are familiar with the key terminology here.
So this is our S3 series, our SaaS startup series. Well, that S3 series, that would be another S. So sorry. SaaS startup series, a lot of S's here. And we're going to go really deep into SaaS startups. And our first part of this 3-part series is going to be going over a lot of the different terms that are going to be familiar with a lot of tech companies. If you've been in a tech company or working with one, then these are going to be terms you probably are familiar with. But if you haven't, if you've been adjacent to it for a while and you start hearing these terms, some of this stuff will start making more sense as we go into it. All kinds of crazy words here. We're talking about seeds. We're talking about SAFE. We're talking about series. We're talking about CACs and LTV. All kinds of crazy stuff that we're going to go deeper in. Thanks for gathering all this stuff together for our students, Nikole.
Yeah,
Ready?
definitely. I know talking with my team, sometimes they'll be on a call with a client and they'll be like, the client's using all this terminologies. They're on the side Googling what all that means. And I mean, over the years, we've become more familiar with this space, but there's definitely a lot of acronyms and terminology to understand here. Typically, the way this type of business would start is you would have a young entrepreneur, not always young, but a lot of times they're young, and they've identified that there's a problem that they want to solve. And generally, they may not have a product yet, but they've identified the problem. And so they want to go out and raise money so that they have cash to then build something so that they can solve this problem for the market. And so generally when they go out, the first place where we look when we need money, usually they're going to go out to their friends, family, and say, hey, I have this really good idea. Would you be willing to invest in me so I can put together an MVP, a minimum viable product, so that I can take that MVP product and go to institutional investors and get more funding. So it's just a minimum amount to get something started.
A lot of founders of these funding rounds add another F to that, friends and family. They say friends, family, and fools. So There's an F theme going on here. The founders fund is with friends, families, and fools. That's usually what they say is like tongue in cheek as a joke. Anybody that they can gather money from and anybody that will be willing to take a chance on somebody. If it's somebody you're going to run into them again too. Like this isn't somebody you can avoid because it's Thanksgiving dinner now. And I've just loaned you $200,000 for your product, or the thing that you're building. Let's see what's happened to that kind of thing,
Right. And I think if you're on the giving end of that, just go in with the expectation that you're not going to get that money back. And if you do, good. But think of it as a gift rather than an investment. How about that?
Yeah. That sounds about right. And that's usually what they have. I mean, that we say it tongue in cheek, but that's usually what the expectation is at the beginning is, generosity too, just kind of like helping this kid figure this out, solve this problem too. And maybe you're close to the problem. Maybe, some of the friends are people that, it's solving some of their problems too. So they would like to see this product come to life.
So after that friends and family round, then you get to the pre-seed stage, and that's still a very small early investment. And that's typically to develop a prototype, start doing market research. In the very beginning, you have to do a ton of research. You need to talk to as many people as possible to understand truly what their challenges are. And a lot of times startups, what their initial idea is for the product or the solution is completely different than what it ends up being, because as they start to go talk to people and iterate on it, it ends up being completely different. So that's a super important part of the initial startup phase.
Yeah. Is the seed a metaphor for like a seedling, like an actual seed? You're planting a tree and it starts out as a seed, right? And it grows to something large over time.
If I had to guess, I would assume that's probably where it came from, but I did not check.
Okay. I would think so. I mean, I think a lot of these things are just easier ways to remember things.
Okay. So typically during these rounds, as the startup is getting investors, they will issue a document called a SAFE, which stands for Simple Agreement for Future Equity. And it's a SAFE note. It's like a loan that converts to equity. And so the reason they do this instead of just give you shares in the company is because every time that they raise a round, they would have to go get a valuation. Attorneys would have to get involved. It's really, really expensive. So the SAFE note is an inexpensive way for a investor to invest in the business. It comes in, it's a note. And then at a certain stage, like usually during like when they get to A round, that's when it would actually convert into real equity based on some established valuation. So after pre-seed comes seed round. Again, that's just continuing getting small amounts to continue to develop the product before they go for the big. Usually the seed round that ends up being typically when our clients I see, it's like at least $1 million, but that's like a much bigger amount than the pre-seed and friends and family round. That's like, okay, you've got institutional investors, you got real people, you may have people on your board. You're giving away equity, a lot of equity at this point. You have people on your board of directors. And something to think about is if you are getting investors is that you're giving away equity, one, and two, you're basically working for them. So make sure when you're getting investments that it's from people that you would want to work for, right? Because they have a lot of say and input in what you do, and you're constantly having to report things to them. So just be aware that when you get investment money, you're not necessarily the boss like you would if you were just bootstrapping it. And bootstrapping meaning that you fund your own company with your own cash.
So you talked about in the seed round often is led by angel investors or VCs. Can we let the students in on what that means? What is an angel?
Oh, good idea. An angel investor, that would be someone like, I think you and we've invested in some of our friends who have startups in the
SaaS
accounting space, SaaS accounting space.
Yeah.
So that would just be like a solo qualified or accredited investor. I think for an accredited investor, you have to, what is it? You have to have $1 million in assets or make $250K a year or something like that. Mm-hmm. So that's some sort of accredited investor, just a solo person that's willing to invest in your product. And then VC, that's venture capital. That's like people that usually they create funds and then they go out and they're looking for businesses to invest in. And they're usually coming with much bigger checks than people like you or I would.
When we refer to VCs in this series, that's typically what we're talking about. And what are some of the other early stage people that would come in? Private equity wouldn't come into play here into something like this, would it?
Yeah, it's funny. And I'm not like a big expert in that space, but usually when I see private equity, they're coming into like normal operating businesses, and then venture capital, I think more of SaaS startups. Startups. Yeah. So their
Fair.
expertise is normally in the technology space. And so they have, because some of this technology stuff can be really complex. And so they have certain experts on their team. They have a process that they run. They make sure you, like, if they're investing in you, typically you have to get an annual financial statement audit or review. They have quarterly reporting requirements. So they have a process basically.
And so that's typically why we're going to refer to that more and more during this series.
That's right.
And so, yes, the seed is the start of that growth then. Now we're at the seed round, so our students know what seeds are. That's the metaphor here that we're driving as we grow this SaaS startup.
Yep. And then typically at Momentum, we're servicing them after that seed round. That's usually when they have enough to put in proper infrastructure in terms of starting to hire employees, getting an accountant in place, getting an HR team. They're growing really fast because they go from having zero money in the bank account to millions of dollars. It's not like a normal operating business where you grow a little bit at a time. It's like, all right, it's real now. Now you have to come start spending money.
They have an MVP at that point, right?
They have an MVP.
Minimum viable product.
At this point, they're probably pre-revenue. They may not be. They may have some customers. Sometimes they may not have any customers at all, depending on what they're building. And so the investors are like, here you go. Here's some money. You have, as long as you can stretch out that money to basically get us then to Series A round. One option would be with that seed round, they can go create a business that generates revenue to cover cost, or alternatively, if they're still in the development phase and they end up running out of cash after the seed series, then they can ask the investors to do a Series A round, which would usually be a much larger round than the seed round.
Okay. And typically, to give some scope, what are usually Series A rounds? How large are they? In the millions?
Well, I think I'm not sure, but we've seen some 100 million, 200 million. I don't know if those might have been later rounds though. I'm trying to think of the one we just saw pop up on, what's it called? Finally, they're a bookkeeping company.
Oh, wow.
Finally raises 200 million. Let me see. Series B.
It's Series B. But in the Series A's, you're seeing these are in the millions. So they've got millions in the account.
Yeah. So Series A is usually anywhere from like 2 to 15 million. Usually it's around like 6 to 8 million.
All right.
So, and each is,
go ahead.
I was going to say, like, the purpose is you don't want to give a company $100 million before they even have the product developed, because they're just going to go whittle it away. So you want to give them small amounts to make sure you trust them. And then when it's like, okay, you've got a product, customers want it, let's infuse more money into this thing and scale it as fast as we can, because we've proven that it's a good business.
So let's go back to when you were talking about the SAFE, the simple agreement for future equity. That changes over during the Series A. Is that right?
Yeah. So typically as an investor, like when I invest, I always ask, what are your plans for raising more money or exiting? Because I want to know as an investor, when am I going to get my money back?
Yeah.
And so typically Series A is when your SAFE notes would convert to equity. And also during that time, as an early investor, there could be an opportunity to sell all or part of your equity to one of the larger VC companies that are coming in if you want to cash out some or all at that point. Usually at Momentum, we have some Series A clients, but typically that's when they have enough cash coming in where they start to hire in-house. So we're usually getting them from seed series to Series A. And then after that point, they may end up hiring an in-house controller or something.
So let's get on to burn rate. What's that?
You know what the burn rate is.
I want to hear what burn rate is. You want me to explain it?
Yeah.
So it's the rate at which startups are spending cash reserves to cover their expenses. They're burning cash Is that like where the metaphor is here? Like it's as if they're setting cash on fire because they're not earning anything on that at the time, right?
That's right. Yeah. So it's basically how much cash on average every month are they burning, they losing.
Burn it, earn it just to burn it. Well, they're not
And
earning it; they're just burning it.
and the reason we want to know that is because it helps us calculate our next term here, which is runway. So if you think of a plane that's flying and they have to get off the runway before the cliff,
Yes.
that's what that is, right? So
So you're burning that cash, and the cliff is the last bit of cash that you have.
Yeah. So if our
before-
burn rate's 10,000, or let's call it $100,000 a month, and we've got $1.2 million in the bank, then we've got a year. We've got 12 months of runway before we're going to fall off that cliff.
We're looking for lift
liftoff.
off at some point during this while you are burning. You only have
Yeah.
this much to burn through. So it's very important that you're getting reports and that you are looking at your forecast in these scenarios. Is that right? Do they rely on different forecasts to give the runway? I guess I'm going too fast here.
Right. So you can do a forecast, but you can also look at this historically to see, what is my average burn per month? How much cash am I going through per month, and how much cash do I have in the bank account? So that's a pretty easy calculation that you can do. And so typically what we see is every month the runway, the number of months they have left to figure this out, goes down and down and down. And so the owners, or the CEO or the founders, they have to either figure out a path to profitability so they can start generating their own cash through the business. Or what they do is they say, we're still developing the product. We're not at the revenue stage yet, or we're not going to be able to achieve enough revenue to get us to profitability. So we're going to go start trying to raise another round to give us 3 more years or whatever it is of runway.
Oh, okay. Yeah. So that would be why would they go into the next series? The series B, another round of money, more runway, more cash to burn.
And a lot of times, after they get that seed series, they could probably pull a bunch of expenses out and operate on their own as a profitable, normal operating company. But a lot of times they want to pour fuel on the fire and scale it as fast as possible so that the investors can then get an exit at like a crazy multiple. So SaaS companies have much higher multiples than a company like yours or I, right? So ours are typically, maybe 1 to 1.5 times revenue, whereas SaaS companies, at their peak, they were up to like 20 times revenue. I think right now they're probably like 6 to 9 times, depending on the market.
What's the holy grail for a SaaS company? Are they trying to go public and IPO? Is that like the big time, or is that when they've just gotten started, when they finally IPO? They finally gone out of a startup and they're established.
Well, the IPO would definitely be when investors would, and also employees who have stock options, would get a big payout. There's also, most of the time, they end up getting acquired. I don't know what percentage of companies actually do IPO, but a lot of times it's like some other acquisition, which is, again, is still a good opportunity.
That's an exit.
That's an exit. Yeah.
Yeah. So an IPO for our students is initial public offering. So when we say go public, that's when they go IPO.
Yeah. And usually when you have investors, their incentive is to get their cash out as quickly as possible. So they're not looking for you to hold this as a lifestyle business. They're looking for you to grow it as quickly as possible, sell it, exit, so that there can be a liquidating event.
Mm-hmm. So everything is always at high speed with startups. Everything is fast. You're always all hands on deck. Everybody's wearing a lot of different hats when you're working within these startups too, because they're trying to do everything and they're trying to do it fast. Grow is the name of the game. Grow that seed into a tree. Rewind for our students, episode 25, we talked about customer acquisition cost and marketing. Can we also go a little deeper into that? What is CAC? CAC.
Yep. So we've talked about this a couple times. CAC is customer acquisition cost. So it's what is the cost to acquire a new customer? Because typically, and you're in the startup phase, all you're doing is trying to get more customers. And so other than after you've built the product, now you're trying to sell it. And so we want to be really clear on, when I spend $1 in sales and marketing, how much in revenue is that going to get me? So that's a vital metric, because otherwise, if your customer acquisition cost is too high, then your business model is broken. And so you're just like dumping money into marketing, and then the revenue that you're getting from that is not enough to cover your costs. So you're just going to end up in a crappy, inefficient growth model.
And then that brings us to episode 24, LTV, lifetime value of our customers.
Yep. So the LTV again is the average value of a customer over the lifetime. And so if you have a client or a customer that pays you $500 a month and they stay on average for 3 years, then you just multiply, 3 years times 500, and that's your lifetime value. And then that is an indicator of how much you're willing to spend to acquire that customer.
Cool. And we all want to know about churn. What does this churn mean? We're not churning butter here, but it is similar in a way that when you churn butter, you're churning it over, and you got some kind of device, I guess, that's like stirring it, right? That's kind of how you would think about it with clients or whatever you're churning, whatever your churn rate is.
Yeah, churn is a really big metric for startups because you spend all this marketing dollars to get those customers in the door. You have customer support that you're dedicating. And so it's, as we all know, it's much easier to keep a customer than it is to go get a new customer. So a key metric that startups would monitor would be their churn rate. Typically the churn rate's anywhere, like a decent one is less than 7%. With B2C type businesses, you'll be on the higher end, versus B2B and enterprise type businesses, you should be on the lower end.
And what does B2C mean or B2B mean?
Oh, okay. So yeah, if your product is something that you're selling to consumers, like individual people, versus B2B would be
the end user. So if you're selling to the person who's going to be using it, that individual, that's the B2C, that's the customer.
Client. That would be like your Netflix subscription.
Yes. And then B2B is business to business.
And that would be like your
professional services.
Google Workspace.
Okay. That's a B2B.
And then enterprise would be you're selling into Google, or you're selling into Microsoft, or you're selling into Audi, some of these big companies. And that's like, we hear about people who do software sales. You'll hear people that are like more enterprise sales versus B2B sales versus B2C. Anyway, I guess the concept there is like individuals are more likely to cancel a subscription, right? We might try something versus if you're
also lower cost. To the subscriptions tend to be lower prices for the individual. So they can, I guess they have higher volume, whereas the B2B might be a lower volume, but it's a higher value per subscription.
Higher value. And then also, if you think about it, if you're selling into a business, that software is being used by the entire company. And so it's not as easy to like plug in. Like I can turn off Netflix and go watch Hulu. If I had to get rid of my project management software or Google Workspace, that would interrupt my company. And so it's a much bigger decision. It's not as easy to turn on and off. More sticky.
Yep.
Sticky.
Cool. Well, we got some bonus terms for you late students who are staying late to class. We got some bonus activity for you. A lot of R's here. This is where we get into the R's. So your bonus is an MRR, ARR, and NRR. What are all these R's, Nikole?
Mer. Yeah. So MRR is your monthly recurring revenue. So that's, your subscriptions basically. Typically, we want our customers to be paying us at the beginning. Like if you can get a customer to prepay for a year, that's fantastic. So they may pay for the entire year, but our MRR, we have to divide that by 12 to get our monthly recurring revenue. So if I sell something for $12,000, my monthly recurring revenue would be $1,000 per month. And then my ARR, annual recurring revenue, would be $12,000.
Okay. So we're looking at the cycle of revenue when people are going to pay again. And subscription models, you really are focused on your those kind of metrics, the ARR and your MRR, whichever one you're tracking. Your MRR, that's your monthly revenue. How many people are subscribing to your product? How many customers do you have? Users, as they say. Software is very similar to cartels in the way that they refer to their products and their clients, their users. They both have users. There's some other similarities too that I haven't really got into. But yeah, high profit margins on these software companies that we're talking about here, these startups. It's worth it. This is why people invest in startups, and this is why there are a lot of SaaS startups, is because once they do become profitable, they have a lot of recurring money. And once they do become, is that what it is? Profit, when they reach profit and they have that critical mass, or what do they call it? What's the point of profitability that they hit, that you're looking for with a client? That when their runway is done, they've got a product, they've got clients. What's that? What is that called?
Well, typically, if you go back again to the 50-30-20 rule, right, we want no more than 50% of our revenue to go toward COGS. With SaaS companies, it's more like that 50 is more like 25%. So their gross profit margins, for every $1 they sell, they're only spending about 25 cents to service that revenue.
Yeah.
So really high gross profit margins, which means much higher valuations because there's no people component of it, right? They sell one software, there's very limited other than some customer support and then some increased maybe hosting fees. There's
usually
not a lot
your
that
people
goes
are
into
in
it.
marketing and in sales or in that some customer service. That's your people cost, but you can service a lot more across the board. You can do more with less. Is that what you're saying?
That's right. Yeah. It's not like with our types of businesses where when we get a new client, we have to hire a new person and then that person's meeting with that and they have a relationship. Anytime you add more people to the mix, a lot of times tech startups may have a professional or service component of their business to test it because do they have to have proof of concept, right? Think about some of the software in our space that I think maybe Digits started with a software. Then they said, oh, now we're going to do bookkeeping services for you. And then what they'll end up doing is they end up selling off the service side because the service side valuation sucks. And then they have this service side, the SaaS side, proof of concept, and then they'll sell off the service side. KPMG Spark did that. I want to say.
Okay. Yeah.
Or maybe they
because
just
it's a higher
ended
multiple
it.
because it's worth a lot more. In the end, it's a lot. The company is more profitable, but that serves an R&D element, and we're not going to get into R&D here. But them starting a SaaS or a service-based company was their R&D for the SaaS company too, and then splitting it off only makes sense once they don't
and I
need
think
that.
We'll get into this next episode with the financial KPIs, but as advisors, we want to make sure that we understand the service side of their business, those KPIs and those targets, and that business model is different than the SaaS KPIs that we need to track. So we need to make sure that we understand those two components and then we're tracking those separately.
Right. And so for a SaaS-based company, there are going to be different metrics that are important to them based on a lot of these foundational terms that we discussed today. So tune in next week for part 2 of our SaaS startup series.
We're going to get sassy. So next week we're going to be going through how to set up your profit and loss statement, what financial KPIs you should be getting. And then our third episode will be about what reports you should be looking at on a weekly, monthly basis, what you should be reporting to investors, and how to automate those reports.
Dope. All right. Tune in next week. Peace out, homies.
See you later.
Yeah. So you're drowning in cash flow issues. You run a business, but feel like it's running you. Customers won't pay, but you got bills due. It appears you won't have enough for payroll coming up soon. It seems like you running nowhere fast. You work hard, but never able to withdraw cash from the business. You get more customers, hire more employees, but still take home hardly anything. You feel like you're on a hamster wheel, frustrated cause the battle's always uphill. Even though you got a bookkeeper on your team, they send you reports, but you don't really know what they mean. Your CPA doesn't understand a thing about your business, at least that's how it seems. But if you want to get above water and grow, check out the Cashflow Show. This is the Cashflow Cashflow Show, where we help the small business gain momentum and become profitable. This is the Cashflow Show. Listen and learn. We'll show you how to pay yourself on what your business earns. Cashflow Show. Discuss topics like getting paid on time, profitability, and managing your bottom line, payroll best practices, the best apps to use, and cash flow forecasting tools. So if you're a small business owner, your help's right around the corner. Fret not. Tune in as Scott and Nikole help you reach your goals on the Cashflow Show. The Cashflow Show, where we help the small business gain momentum and become profitable. This is the Cashflow Show. Listen and learn. We'll show you how to pay yourself on what your business earns. Cashflow Show. Our advice will take you far. Cashflow Show. Tune in with Nikole and OKR.